Hello. So it's great to be here. And one slight correction: I'm now Professor Emeritus at UMass Lowell. I went there in 1993 from. I was at Barnard College, Columbia University, in a tenured position, and I went there to build a program in regional economics, social development, which was totally successful. And then, however, there was a change in regime. A politician came in, his name was Marty Meehan, and he destroyed our program. But he didn't destroy the intellectual capability because I had some really good students in that program. It was a master's program. They're still working with me, and they're why I have an organization now. It's a 501c3 organization. Called the Academic Industry Research Network, which I started in 2010 because I thought, okay, the university doesn't want me to do this research and to have a critical view of what's going on in the economy. Well, we'll do it another way. And fortunately, the Institute for New Economic Thinking came along and has generously funded our research over the years. We wouldn't be able to exist without their funding. I recently, last May, retired. My three daughters held an unretirement party for me because they knew what it was really about. It was so that I could spend all my time research and writing and keeping up with all these great researchers I have working with me to get the research out on a variety of issues that I'm going to talk about. Okay, now what I'm going to talk about today is going to deal with really 5 issues, but the 4 issues I'm going to deal with fairly quickly because I want to get to the question of market fundamentalism, which is fundamental. So I'm going to talk about what buybacks, what they are very briefly, how big they are. I'm going to talk about why they are a problem. Who benefits from them, and Ralph's already said a few things about that, and why they are permitted. And then I'll get to really the crux of it is how they are legitimized. Why you can have this phenomenon going on, which really nobody can defend. Tim Cook, when he was asked about these buybacks last May in an interview, he said, well, you know, some people are going to pay capital gains taxes on the money they make from the buybacks. This was his only answer after getting all those tax breaks, including Apple, from the Republican tax cuts, which is kind of either a cynical or idiotic or ludicrous argument. I called it a quarter-baked argument, and that got into the headline of an article in Business Insider, and it wasn't probably even 100th baked. It was nothing. It's not an argument. So there is no argument. Okay, well, let me get into the first question. Okay, so buybacks that we're talking about, there are different types of buybacks, but we're talking about open market repurchases, where a company just tells its broker to go into the market and buy back its stock and create a demand for its stock. That's the vast majority of buybacks that are being done, that are measured in the economy, reported by companies as stock repurchases. And they are generally done, the purpose, not in every case, but usually just to boost stock prices. And they're generally done when stock prices are high, not when they're low, so the company isn't getting a bargain in doing the buybacks and starting to buying back stock and then issuing stock at higher prices. That's not the way it works. In fact, if this company was to do that, then they would be signaling that the price of the stock is overvalued, so it doesn't work that way. It's actually a competitive process where companies are getting in there and trying to keep up and boost the stock price, and it's what it is a manipulation of the market. And I'll come back to that when I come to issue number 4, why they permit it, or why the SEC permits it, because it basically says that you can permit the market being manipulated, and in the process, the subtitle of my we gave to my talk, the free market ideology for free market ideology's license to loot, is that that's what the SEC basically has given companies since 1982. I'll come back to that. Okay, they're big. So just to take some of the more recent data for the last half decade, 2013, 2017, for 492 S&P 500 companies listed over those 5 years, they were $6.2 trillion, so that's averaged about $1.1 billion per year per company in buybacks, and that's not Instead of dividends, that's over on top of dividends. Dividends were about $2 trillion, about $800 million per company per year of those 492 major companies. That was 56% of their net income as measured, and another, in buybacks, 42% in dividends. Okay, and so they're not actually stinting on dividends. They're paying a pretty reasonable amount of profits out as dividends. Okay, so they're big. Okay, why are they a problem? They're a problem because retained earnings, the money that a company makes out of profits, are the foundation of reinvestment in the economy. It's not the stock market that is reinvesting in the economy. The stock market is not an institution. It never has been an institution for putting money into the economy. It's a way of getting money out of the economy. The reason you have the managerial corporation beginning of the 20th century is because of the need for separation of ownership and control. And it wasn't because a lot of people put money into companies and because their companies got so big that you had to have a lot of capital. The companies that grew had internally generated funds. They could use the bond market to leverage them. The reason why you had a separation of ownership and control is that because if you wanted to build a company, you had to have people in power, and hopefully you do, and hopefully you did. It's not always the case, but you needed to have people who understood how to manage those complex organizations. Okay? And that's what we call the managerial revolution, and I work closely with the business historian Alfred Chandler. If you haven't read his work on the visible hand, you should, a 1977 book in particular. And that was complete by about 1920. And so we had employees by the 1920s in charge of major companies. And so where are the shareholders? The shareholders are just buying and selling shares by that point in time. Okay, I'll come back to that. Okay, so it's a problem because you're taking the money that needs to be reinvested in the company. Now, it's not just physical capital. What differentiates a company, one company from another, is not the plant and equipment they put in place, because anybody can buy the plant and equipment. If you develop unique physical capabilities, unique machines, well, you're doing that with people. You're doing that with engineering. You're doing that by investing in the productive capabilities of people. So you might call this capital formation. I call it investment in productive capabilities. And what differentiates companies, allow them to grow, is when they invest in the productive capabilities of people. Now, some of those things are fairly simple, productive capabilities that are just doing administrative work, opening the doors, closing the doors, turning on the lights. But if someone isn't there to do it, a lot of things can grind to a halt. But a lot of it's very complex productive capabilities. Okay, so that's why you need to have this money reinvested. And of course, doesn't mean that it's going to be reinvested well. You need to have good management. You need to understand good management. And one argument I would make more generally is that top executives who are thinking about how they can give away money to people who don't matter to boost their stock price are not really thinking about how to run their companies now, and they're certainly not thinking about how they can create the competitive products of the future. Okay, so that's a big problem. It's a problem of distribution because, in fact, when we see rising wages, rising standards of living, it's because companies are profitable. The profits aren't bad. It's what they do with the profits that's the issue. They're not sharing the gains with their employees. Now, they're not giving out the money to employees just because they like to give out the money to employees. It's part of a productivity pay dynamic when it works. Employees are incentivized, they return to work, there's little turnover, they cooperate, they know who to work with. I call it collective and cumulative learning. There's a lot that's going on that's very complex, that goes way beyond economics or finance, that's going on that makes our economy prosperous. And that's undermined once you start doing buybacks. Now, there's a more general perspective that comes out of this, and it's just one example of it, which is being raised in this context of this discussion of market fundamentalism, and I'll come back to it, but I'll just mention it here, is that if we want to understand markets, we have to understand that organizations create markets. Markets are outcome. This is very much in keeping with the work of Karl Polanyi, for example. But it's basically well-developed markets historically, and I get this from just doing comparative historical industrial development over the last 40 years, looking at different countries, different places, different times. Labor markets, capital markets, finance markets, and product markets, they're there because you have successful organization. And it's not just states and governments, it's companies. And so these companies are basic, the businesses are basic units, and some of them, of course, are bigger than whole states when they really grow big. Amazon now employs probably close to 600,000 people worldwide. That's up from about 88,000 in 2012. So when these companies grow, they become very big, and how they grow and how they distribute the gains is very consequential. Okay, so that's why it's a problem, because you're actually eating the seed corn. You're not supporting the organization. You're doing just the opposite. And that's, I use these terms, which Ralph mentioned as a subtitle of an article that Brookings put out in 2015. You're going from retain and reinvest to downsize and distribute. And I think it's a good description of the change that occurs once you, and buybacks are emblematic of that. Okay, why do they do them? Well, and Stephen Clifford is going to talk more about this, but if you look at executive pay, the bulk of it is stock-based, particularly in the companies that do lots of buybacks. So we have measures, let's say for 2015, the 500 highest paid executives in the United States averaged over 33 million. 2016, it's about 27 million. About 80% of that is stock-based pay. Stock options, stock awards. And by the way, almost every number you read in the media about what executives get paid is a phony number. It's based on grant date prices of options and awards, not on what they actually get. And we know what they actually get, but that's a whole longer discussion about how the SEC privilege what's called estimated fair value measures of stock award, but it's actually related to this because it's based on bad economics. Really, nonsensical economics called Black-Scholes-Merton's option pricing models, which were first put forward in 1973 to try to estimate getting a price for gambling on an option that you did on the actual market 10 days out, where no one knows what the outcome's going to be. And it basically assumes a log normal distribution of stock prices, which is not what happens when you get a big stock price boost that allows you to get high realized gains. And that's where stock buybacks is. That's part of the name of the game. There's other things related to it, like in the pharmaceutical industry, price gouging, but you price gouge and you do the buybacks and the executive get the pay. But it's not just the executives. The hedge fund activists have become extremely more powerful in doing this. They've been enabled by a proxy voting system, which is corrupt because it basically gives pension fund managers, mutual fund managers, not just the right to vote shares, but the obligation to vote shares. And so now a hedge fund activist, as is going on with Nelson Peltz at GE, Procter & Gamble, DuPont, can get less than 1% of the shares in some cases and determine who's on the board, even without a proxy fight, by lobbying the proxy advisory services, ISS and Glass Lewis, and getting enough alignment from pension funds, et cetera. And that's a whole other discussion. I don't think the pension funds gain from buybacks. They would gain from more dividends or from dividends, but that's another discussion. But it's basically now there are these very powerful individuals. Sometimes they lose money, like William Ackman with the Valiant, but a lot of times they make tons of money. And Paul Singer, Carl Icahn, you know a lot of these names. Okay. Why are they permitted? Okay, we start getting into the market fundamentalism issues. It's at one level pretty simple. I'm here with Ken Jacobson, who we're finishing a paper, hopefully have it done within the next couple months. We've been working on it for about 3 or 4 years, on the adoption of Rule 10b-18 in November 1982 by the Securities and Exchange Commission, and which basically is the license to loot. It enables companies, encourage companies, in fact, to do buybacks. It says you can do up to 25% on any day of your average trading value daily trading volume over the previous 4 weeks, and it's a safe harbor, so even if you go over that amount, you won't necessarily get charged with manipulation of market. And in fact, the SEC does not collect data on this because the chair of the SEC at the time, John Shadd, thought this would just be too burdensome on companies, and companies, we heard this before here, will self-regulate and don't worry about it. Okay, but by 1984, so this is not something new, that's when stock buybacks started. Now they've escalated, they've gotten greater, but it's not something that just happened in the last few years. Okay, the reason 10b-18 was adopted was simply Ronald Reagan got elected on a platform of deregulation. And he then chose Shadd, who was the first guy from Wall Street to come to be the head of the SEC since Joseph Kennedy, at the outset of the SEC in 34, 35. And he had been the head of the first person on Wall Street to come out for Reagan in 1980 and the campaign, and had been the head of his New York campaign. And so this was the reward. And he immediately brought in Chicago economists, and they really drove out the regulators and captured the SEC and adopted this rule under the radar without public comment, 10b-18, which I just mentioned. So that's why it's permitted. It was the implementation of free market ideology. Now I'm going to come to the last question, and that is, what is that ideology that legitimizes this? Now, when Rule 10b-18 was adopted in 1982, if you'd gone to someplace, I was around there at the time, I was at Harvard University, I wasn't hearing shareholder value from anybody. And in 1984, I became a research fellow at Harvard Business School, right across the river. It's not really the same universe as on both sides of the river, but no one was talking about shareholder value. But then, with the urging and the help of the president of Harvard University, Derek Bok, and the dean of Harvard Business School, John MacArthur, they recruited Michael Jensen to be a professor there, and then it was on the agenda. Now, it wasn't just created by Jensen. There was all the stuff we know about the RJR Nabisco stuff that happened, the deal decade. That was all building up. There's a very good article that's been written which shows that in the Wall Street Journal, mentions of shareholder value only starts around 1985. But then it really takes off and becomes a dominant ideology. And it comes out of neoclassical economics, which I call the theory of the market economy. And it basically is an argument that of all the participants in the corporation, only shareholders take risk. Everybody else gets a guaranteed return. Why do you get a guaranteed return? Because it's all determined by the market. Okay, but that's false. Okay. We as taxpayers, when we pay money that goes into infrastructure and knowledge that companies use, if we don't get a decent tax rate, or the companies don't make money, we don't get our tax revenues as households back through the government. If they then use the political process, as we know they have, in the name of shareholder value, to say we need more money to invest, then we get screwed by this ideology. And okay, the other people who are messed up by shareholder value ideology and left out are workers. If we just had companies that hired workers and paid them the going wage today and didn't care about whether they turned up tomorrow or their incentives or developing the products of the future or cooperating with the company not only over months and years but over decades and at all levels of the organization, we would not have a productive economy. We would not have productive enterprise, we would not have a productive economy. But as a worker, we know we take risks. So among the few who don't take risks are people like me who got tenure and at least couldn't be fired, even if they might have liked to do that at UMass Lowell, but they couldn't, so I end up retired with a nice pension, but that's unusual. But actually, coming into the 1980s, people who worked for large corporations had a career with one company. Companies did not fire people. And that all changed with shareholder value ideology, and the risk that workers were bearing was borne out. And we can see that in stagnating wages, and then even in a company like Amazon, which says they're paying $15 minimum wage, that's just over $31,000 a year. That's still, for one of the most successful companies in the world, owned by the richest man in the world now, that's not much of a wage. Okay, so it's an ideology of who takes risk, but it's wrong. Now, do shareholders take risk? No, public shareholders do not take much risk, because they only buy shares because there's a liquid stock market and you can share them anytime. You can sell them anytime you want. And you have limited liability, and you don't need to know any companies. Of course, the pension funds and mutual funds, they're holding thousands of shares. And that's why you have the proxy voting system, because they say they vote the shares, but they don't have any idea how to vote the shares. Okay, now the part of this, which then goes somewhat deeper, and which because I only have a couple minutes, you can read some of the papers, including, so there, you can find them on the website of the Institute for New Economic Thinking, most of these papers, is that the theory, the economic theory underlying shareholder value, has a theory of the firm, which is taught to millions of people every year by tens of thousands of PhD economists, and has been done this way since Paul Samuelson wrote his 1948 economics textbook, which says, I can't explain this all, but you can read my papers, that the most inefficient, the most unproductive firm is the foundation of the most efficient economy. And it's called perfect competition. And the way you get perfect competition is by having a small, unproductive firm. That's a U-shaped cost curve, and it goes up at a very low level of output. Okay, now, once you do that, you have the market is relied upon to allocate resources, and I'd say the market is omnipotent and the firm is impotent. And if we have impotent firms, we don't have a productive economy. We need to have firms that actually invest in productive capability. And Paul Samuelson had no conception of this. Neither did someone who was not that different from Paul Samuelson. I always argue this because I grew up in an era where the two gurus were Paul Samuelson of neoclassical economics, Milton Friedman. And Milton Friedman in 1970, as probably most of you know, had an article in the New York Times which is seen as the clarion call for maximizing shareholder value, called the social responsibility, only social responsibility of a company is increases profits. Okay, now I want to tell you something about this because it's actually related to something that Ralph Nader wrote about, which we all know, unsafe at any speed, General Motors. That article, and I only learned about this relatively recently because the article was cited everywhere. You could read the text, but you didn't necessarily see the original as it appeared in the New York Times. So a guy named Michael Lazonick, who's at INSEAD, who did some good work on stock buybacks, sent it to me. The original shows a picture of James Roach, the chairman of General Motors, at the shareholders meeting in May of 1970. The article appeared in September of 1970. And then there's some editorializing from the New York Times. It says a Milton Friedman doctrine, and it has the title about the only social responsibility, et cetera. And then it says that in this article, Milton Friedman says that the author, Milton Friedman, I'll read this out, calls such drives for social responsibility in business as unadulterated socialism, adding, businessmen who talk this way are unwitting puppets of the intellectual forces that have been undermining the basis of a free society. Okay, that's his argument, and then creates the profits. Now, the context is important. That article appeared, there's absolutely no doubt about it, because of a shareholder proposal in May of 1970 to put 3 public interest people on the board of directors of General Motors because they wanted more fuel-efficient cars and safer cars. Okay, and this was what they were arguing for. And then we go ahead and we look at subsequent history of the automobile industry. What didn't General Motors do? As the Japanese came up with more fuel-efficient cars, it did not come up with more fuel-efficient cars. As the Swedes and others came up with safer cars, it did not come up with safer cars. It did try to learn from the Japanese, but then it killed Saturn where it would have costed $5 billion to go from a small-sized car to a mid-sized car, but it didn't want to cannibalize its business model, and the unions were involved in this too, in the rest of General Motors. From 1986 to 2002, where then they were supposedly competing against the Japanese, General Motors did $20 billion in buybacks. It was a lot. And I guess they had no other use for the money. Okay. I did a calculation when General Motors went bankrupt that if they had just gotten a 2.5% after-tax rate of return on those $20 billion, given when they had spent the money, they would have had about $35 billion in 2009, when we, the taxpayer, put in about $49 billion to bail them out. The unions put in a huge amount as well, 20,000 layoffs, all kinds of wage cuts, et cetera. A $1 billion loss on their pensions, $11 billion loss in the pensions. We then actually lost money, about $11 billion, when General Motors sold the shares that it had, when General Motors went back on the market in 2010, sold the shares in 2013, and we lost the money. Then, in 2015, a guy named Harry J. Wilson came in, had a secret meeting with the head of General Motors, Mary Barra, that they wanted an $8 billion stock buyback and a seat on the board. He was representing a bunch of hedge funds. Harry J. Wilson was a guy appointed by Stephen Ratner to be on the task force to bail out the auto industry. And in his book, Ratner says, called Overhaul, written after the bailout, Ratner was running the bailout for Obama. He said that he hired him because he was a Republican and that looked good. But he got them, he insisted that it be in equity, not in debt. So we the taxpayers, then would not be made whole if it had been debt. We lost the money when it was equity. The hedge funds, which had put no money into the bailout, came in demanding this money. General Motors have now spent 2015, since then, 2015, 2017, about $10 billion on buybacks, which is about 68 billion, % of their shares, plus dividends. Okay, let me just get back to the last thing I'll say. Milton Friedman. When you look at Milton Friedman and you understand where he was coming from, there's two things. Even before I saw this connection with General Motors, I would say, Milton Friedman, if you read his works, didn't know the first thing about a business organization. He didn't know the first thing about corporations. He was a fraud. Paul Samuelson was a fraud. They're all frauds. They do not understand business organization. They do not understand, as a result, the relationship between organization and market. So when you look back at Milton Friedman's article in this context, what was he telling them? It wasn't just saying, don't deal with social responsibility. He was saying, don't be innovative, and don't put people on your board who want you to be innovative. Now, the last thing I'll say is there is a movement now to put workers on boards. There's Tammy Baldwin, in large part, I think encouraged by the research that we had done on buybacks, has the Reward Works Act, which was put forward in March of this year, calling for rescinding of Rule 10b-18, a third of all corporations' board members be representing workers. Elizabeth Warren has the Accountable Capitalism Act, which was introduced in August for companies with $1 billion or more. 40% of their workers be board members. And the last thing I'll say is, it's likely that, obviously that's not going to happen anytime soon. But if it does, we want those worker representatives, and maybe even taxpayer representatives, to be educated in how a business organization operates and performs. Or else I wouldn't have great confidence that they would go in and do the right thing, as they were trying to do back in 1970, when this group of people, inspired by Ralph Nader's work, clearly, were trying to get General Motors to build safer and more fuel-efficient cars. Thanks.